Okay, so we're going to do fortifying your financial future, retirement strategies for 45 and older. Although what I said, you don't have to be 45 to do this. The younger you are, the better it is to take advantage of investing. So here we go. Topics we'll be exploring: strategies for building retirement savings, balancing different financial goals, and preparing your estate plan. The changing face of retirement. So if you look at retirement, we're ever in a dynamic situation. Retirement has rising costs. If you look at inflation right now, it's 9%. Longer lifespans, you look at we got great hospital facilities in Monroeville. They're preserving life. You get meds, you get great facilities. People are living well into their 80s and 90s at different points. More active lifestyles. You got changes to Social Security benefits. That's a big issue. I'll be 65 in about 15 years. I'm still worried, is it still going to be there? The younger generation, obviously, I think that's a bigger concern. So that's a concern as far as changes to Social Security benefits. Are you saving enough for retirement? The 2020 Retirement Confidence Survey shows that 69% of workers feel confident that they will have enough money to live comfortably in retirement. The funny part is this was taken in March of 2020, before the world ended. Probably if you took this to next month, they wouldn't feel as excited. Overall, how confident do you feel that you and your spouse will have enough money to live comfortably through your retirement years? There's very confident, somewhat confident increase, but that's March of 2020, so that's kind of funny they did the survey then. We all know what happened at the end of March. We hope that doesn't happen with monkeypox. What's your savings goal? Just like any goal in life, you want to achieve something. If you want to run a marathon, if you want to lose weight, which I always try to do, set a goal. So when you want to plan to retire, set a date. If you put things on paper, that makes it now a goal instead of a dream. How much income will you need? Okay, we can do an income needs analysis for that. Obviously, with inflation, we're going to get in that in a couple slides. It'll probably be more than what is right now. And as we just talked about, how much will your Social Security cover? Here we go. Estimated Social Security benefits. So this is taken right off of the first thing you guys should do, men and women, is go on SSA.gov. If you get your Social Security statement, they usually send it to you once a year. Make sure that's accurate. I found out they totally didn't record income from 1998 for me. So that's kind of a bummer. So you want to make sure that that's accurate. It'll tell you what your benefits are at each situation. If you retire at 62, full retirement age, and then at 70, obviously the more you wait, the more they'll give you as far as that goes. But here's a little slide. Income in the last year before retiring, $50,000 a year, 62 in 1 month in 2020. He said, I'm done with my job. I can't work. I hate it. You get $1,045 a month at $50,000 a year. If you wait to 66, that's considered full retirement age. $1,547, and if you're 70 in 2028, you get $2,029. And obviously, the more money you make and put into the system, the more you get. You're making $100,000 a year, you get $3,192. So very important. That's the base step to see where you're at. We can give you advice as far as Social Security, what would be the best move for you as far as when you want to retire and when you would like to take that money. Calculating inflation into your savings goal. Now, inflation usually has been around 3 to 4%, but this is like the 70s. We have inflation right now at 9%. And the last time I remember inflation was like that was in the 70s. I remember watching Good Times on TV and, Jimmy Carter. That's like the earliest I can remember. I remember Richard Nixon going, "Wipe inflation now." He would say that, and Jimmy Carter, we need to fight inflation. So it's really it's super high. The reasons for that is obviously there's been a supply shock from the pandemic. That's demand pull inflation. Demand pull inflation is, I'm using my econ degree. I thought it was totally useless at Ohio State, but demand pull inflation is if there's a limited number of supply, the price is going to go up. There's also cost push inflation, where if there's a huge demand, let's say I make great hamburgers and you love these things, you can't get enough of them. You're coming to my hamburger stand, give me more, give me more. Well, I'm going to hire more employees. I'm going to expand. That could rise into higher prices as far as that goes. And obviously the third reason, the Fed's been pumping a lot of money, the money supply into the economy. And it's really been doing it almost since 2008. If you remember 2008, that was a rough time. And there was a day, I don't want to scare you, but this was September I believe 17th or 18th of 2008. I was at my uncle's funeral. Two major firms on Wall Street, Bear Stearns, Lehman Brothers. Okay, these guys have been around since the Civil War. They've been through everything. They bet the farm on collateralized debt obligations. We're not going to get into all that, but a lot of bad debt. They were over leveraged, and they all just went down the drain. Now, what keeps the financial system going is your confidence in us. People think they put their money in the bank. Oh, it's good. Everything's going well. My money's there and it's safe. No, they're lending that out and they're doing everything else. If everybody wants the money at the same time, it would be like the 1920s. It would be a run on the bank. We'd be done. That almost happened that day. People were just starting to panic when they see on the news that two of the biggest firms on Wall Street just went belly up. People tried to pull their money out. The Fed had to inject, I believe, about 500 or 600 billion into the system just to keep it going. So what the Fed's been doing is they've been keeping interest rates low to try to stimulate economic activity because the economy was dead on the hospital bed. And they really did that a lot. 2008, 9, 10, they've kept interest rates low for a long time. And they did that a lot, obviously, again, with the pandemic. That's why we're 30 trillion in debt. And that's another reason for the inflation. Because if you have more money in the money supply, your money's not as worth as it was before. But here's an example of savings into the goal with a 3% inflation rate. So let's say you have 100 grand today. Got 100 grand in the bank. I'm feeling great. In 20 years, it would cost $180,000 to be worth that 100 grand you got in the bank. So you look here, that's how much inflation is going to affect. So when you have to invest, you have to keep up with inflation. Obviously, right now it's at 9%. We're hoping inflation eventually will go back down to a reasonable level. It usually is about 3% around that range throughout the years. Here you go, between 2010 and 20. Annual inflation rates raised from a high of 3%. We blew that out of the water. To a low of 0.7% was 2.3. So it's really high right now. The Fed's raising interest rates to try to combat that. Now, the power of compound interest. Here's another great example of the time value of money. If you take anything away from here today, and a lot of people, especially when they're in their 50s or later, if they've never saved, they're like, the hell with it, I don't want to do it. Why should I do it? Well, even just starting in a 20-year goal, if you invest just $100 a month, let's say you have $25,000 to get started, and you invested just $100 a month over 20 years, and you can get 5%, which is a very reasonable return for the market. Most of the time the market's returned about 6 to 7% if you're in a balanced portfolio. Just after 20 years, you'd have $106,000. Let's say you put $500 a month away. Well, that's like what, a car payment? It's a cheaper car payment now. If you could stash that away and just forget about it, you start with $250,000. Let's say somebody left you an inheritance or you hit the cash 5, if you don't party it all away. It goes up to $861,720. And if you're really into it, you're stashing $1,000 away a month. Look at this. In 20 years, you can have at just 5%. If you have $500,000 already in there and you just stash away $1,000 a month, $2 million for retirement. So that's the power of compounding interest. And that's really as far as just staying disciplined and as far as savings. Let's take a look here. Tools for building your retirement nest egg. So we're going to talk, old Sam's going to start chiming in here. How much can you contribute to your company's retirement plans, traditional IRAs, and Roth IRAs? Okay, year 2020, IRAs, $6,000 a year. Okay, that's if you're under 50. I just hit the big magic 50. So you can do a catch up of $1,000. So you can do $7,000 a year in your IRA. Okay, employer sponsored plans, that's like SEP IRAs, simple IRAs. If you have a small business, a lot of people think that they can only have a 401k. You can get simpler plans. You get a simple IRA. If you have a lot of employees that are dedicated and you want to keep them happy, open a simple IRA. You can put money into it. As far as that goes, now Uncle Sam's going to tell us why it's good to have an IRA, because we get the power of tax deferral. So Uncle Sam, what Uncle Sam does is he lets you grow that money. Okay, the power of tax deferral. So if you're in a regular brokerage account, let's just say you open up a brokerage account. Okay, here's a hypothetical scenario. It shows savings in a tax deferred account resulted in an accumulating savings of $109,330 and compared to $86,000 in a taxable savings account. So if you look here, the non-blue one, I don't know what color that is. The non-blue one looks brownish. That's the taxable. So you got $22,000. Look after 10 years. You got the blue one moving away. These are all exactly the same investments. If it's exactly the same, you're in the same things that are getting the same return. By the time this rolls around, you're looking at $109,000 compared to, for the taxable savings account, a lot less. That's a power tax deferral. What that means is Uncle Sam, I'm not going to come in, take your dividends, take your capital gains every single year. I'm going to let you grow that tax deferred. Okay? When you have a brokerage account, you're going to get mutual fund companies. What they do is they'll give you capital gains at the end of the year. So if they made money, mutual fund companies just trade every single day. These people on Wall Street. And if they have a good year, you can get taxed at a capital gain. Also, dividends and interest, you can get taxed on that. When it's in an IRA, you don't have to worry about that. Okay? Now, here's the problem. We're going to turn on a little alarm. Let's say you've been in that IRA and you're under 59 and a half. And let's say you want to take that money out. Okay? We got a little warning here. Because what'll happen, what's going to happen, Uncle Sam? Well, if you take money out of that IRA, you're going to pay ordinary income tax. And what else? 10% penalty. I need the money. We're broke. Anyway, so that's a warning. That's what Uncle Sam likes to warn us. He's my guest. He's got nothing to do. So you want to be very careful taking money out of retirement plans. It's got to be a last option. If you have to do it, like if you lost your job, it's going to keep a roof over your head, then do it. But you will get taxed pretty heavily because they're making a deal with you. He's making a deal with you saying, I'm going to let you grow that money, tax deferred. But if you take it out, you're going to pay ordinary income tax and 10% penalty. So try to keep it in there if you can. I know sometimes we have emergencies. Let's take a look. Selecting investments for your savings. So what I do, what financial advisors typically do is we talk to you, generally fill out a risk tolerance form. I try to find out as much as I can about you as possible. A lot of people, when it comes to money, tend to be very guarded. They don't want to tell you, what's going on with their money situation. We're like doctors. We're trying to figure out how we can help you. Unfortunately, a lot of people have their pride in their money and how much money they have, which is ridiculous. So the more honest you are with your financial advisor, the more they can help you. What I do is we take down that information. We'll have a risk tolerance questionnaire. We like to mess with your minds. So if you get a statement and you're down 50%, do you want to go to Mike Wargo's house and talk to him armed? Or, we try to do things because we don't want you hurting us. I mean, that's the number one thing. But for your time horizon, for your risk tolerance. And when people are honest on that, it works a lot better. The real questions are like, if you're down, if you get them, like the statements were a disaster pretty much at the first quarter. We had a rough year so far. So most accounts are down if you're in the stock market. And, how did you react to that statement? I hardly had any clients call because they understood they're in for the long term. They understood that they're in it for the long term. But the problem is you find out if people aren't tolerated because if they're calling you all stressed out, then you got to look at an alternative plan because mentally they can't handle it. So we'll do time horizon, risk tolerance, and your investment goals. Obviously, if you're working, you're growing money for retirement. But if you're retired, the most important part is we want to preserve your capital. If you need that money to live off of and you're 100% in equities and the market drops 50%, that could be a major impact on your lifestyle. Moving forward. Okay, so major asset classes. So this is what we work with. We're financial advisors. Edward Jones doesn't have their own private stock market that goes up. Edward Jones, Janney Montgomery, LPL. We all work with the same investments out there. Bernie Madoff had his own market, but that didn't work very well. His went up all the time. Those movies are pretty crazy, but he got a lot of famous people to invest with him. But asset allocation determines about 90% of the variability in the portfolio's long-term returns. So you look at stocks. Stocks are higher risk, obviously, on the spectrum, but that's where you can get the high returns. Equities. Bonds are about the middle of the mix. Like a lot of people's, their allocations are 70-30 when they're in growth, 60-40. And then as they get older, they increase their bond allocation. Money market instruments, interest rates have gone up, but they're, you see money markets. I mean, they're not really doing much of anything.
Still pretty sucky.
They're still pretty sucky. CDs were big like 20, 25 years ago. As far as that goes. So, if you still want a chance to make the money, stocks and bonds, okay. Stocks and bonds, as far as that goes, that's a risk return potential. Measuring potential returns and risks. This is a cool chart. Different times, different circumstances, different asset categories have performed over the years. So this is if you go back to 1926. So this is performance, $1 invested at the beginning in 1926 with taxes paid monthly, no capital gains taxes. I invested my dollar in 1926. So if you invested $1, this is the different types of asset classes. This is what your dollar did from 1926 all the way to 2016. So small stocks have done the best, 12%. Large stocks, 10%. Government bonds, 5.6%. Treasury bills. Remember, a lot of time, most of the time, the bonds paid higher. This is from 1926. So it's a lot different than today. Treasury bills, inflation. So you invested your dollar, you can enjoy your 26,433 if you're still alive. So this shows you the power of potential risks and returns. These are what different asset classes have done. Treasury bills. This is what inflation. Now I know inflation is really high, but this chart says, and this goes up to 2016, so the data might not be totally up to date. Inflation was around 2.9%. So we're hoping inflation starts to go down. If you saw gasoline, it's $5. It's starting to settle back down. We'll see what happens with that. If we go into a recession, that will definitely bring prices down. Here we go, staying ahead of inflation. Got to stay ahead of inflation. Here's $1,000 today. Your $1,000 is $676 in 10 years, and this is what the normal inflation rate. 20 years, $456. 30 years, $308, and 40 years, $208. So you want to try to stay ahead of inflation. So when you're investing, you got to get that rate of return, but you also have to factor in inflation. Now, right now, it sucks because inflation's at 9%, so you really got to try to get a killer return. But we're hoping the Fed's raising interest rates. Why they do that, it's like a nuclear reactor. They're trying to slow down some parts of the economy so inflation starts to come back down. As I said, if we go into a recession, it's a very big balancing act. If the Fed raises interest rates too much, it could put the economy into a recession. When you see the market go up is when the Fed's going to say, we're going to stop our rate hikes. That's why you're seeing a rally. The Fed's saying they're going to start to back off a little bit on interest rates. But, the future, who knows? So that's staying ahead of inflation. So, if you're in your CD, you're not going to stay ahead of inflation. Balancing risks and timelines. A longer time horizon provides more time to recover from short-term fluctuations that occur with more aggressive growth strategies. So the younger you are, the more aggressive you can be, the more risk you can take. For example, you take a look, this is aggressive growth, higher risk, the blue stocks, 74%, bonds, 18%, inflation hedges, that's things like precious metals, treasury inflation protected securities, things like that. This would be a higher risk portfolio. Obviously, it'd be down more right now because it's in a lot of stocks, but over time, you should get a higher return. Now, if you have a lot of time to recover from that, fine. If you're retiring in 4 years, you're going to need the money. That could be a problem if the market really takes a nosedive. Let's take a look at moderate growth. Here's moderate risk. You go 58% stocks, 31% bonds, inflation hedges 9%, cash. There you go. So that's moderate risk. That's if you're in your 50s, you're getting closer to retirement, kind of want to pull the brakes out a little bit. And then conservative, this is for your retiree. This is your money that you're living off of every single month. You want to have most of the money in bonds. Now, people think bonds are safe. One of the number one things you hear, especially because what's unique about this year is both bonds and stocks have been getting smacked. Okay? There's a seesaw effect. When interest rates go up, bond prices go down. And why that is if you have a bond that's paying 6%, okay? If you have a bond that's paying 6%, and then the interest rates go up, and the other bond's paying 6.5%, the bond has to lower its price, the other bond, to make it attractive. So that's an attractive yield. So when interest rates go up, bonds go down. Now, the double whammy this year so far in the first half of 2022 is interest rates have been shooting higher, like we've all been talking about. The Fed's been raising interest rates. So bond prices have been down. So there's really been nowhere safe to be in investments right now unless you're sitting in cash or, like Tony Soprano, you have something buried in the I just watched the Sopranos episode last night. Okay. But don't panic when you're in a situation like that. Review your allocations regularly. Review your asset allocation at least once a year. I like to look at things at least quarterly. I'll keep in touch with them. I'll keep, in rough times, I'll keep in touch with them monthly, or if it's a bad day, you call them just to hold their hand. Make modifications as your circumstances change. Consult a financial professional. Now, there's a lot of advisors out there. Nobody in this room, I can tell everybody here works hard. But there's a lot of advisors, especially ones later in their career, they may never call you again. They could be on a beach. They got so much, they're just lazy. And the first thing I'll do if I talk to somebody is, when's the last time your advisors called? And if they say, well, back in 2014, well, a lot's happened in 2014. Hasn't he done an allocation call? Hasn't he been in touch with you, he or she? Hasn't they done that? And, that's a sign. If your advisor's not in touch with you, nobody in here, because the advisors that do that aren't in networking meetings at 8 in the morning. But there's a lot that do that. And I love ones like that because I get the accounts from them, and most of the time they won't even know. They're just on a beach somewhere or whatever, or, unless their wife divorces them and they got to pay off half, then they'll be back in the office. All right, leaving your job, weigh your options. I have bad humor sometimes, so if I offend anybody, my apologies. Keep your savings in your company's plan. Okay, so if you leave your job, let's say you're retiring or you're transferring 401ks, this happens a lot. Here's the options you can do. Keep your savings in the company's plan, transfer your savings to a new employer's plan, move your savings into a rollover IRA, or take a lump sum distribution. Now, you can keep the savings in your company's plan. Now, 401k plans really only have a few selected options and like 20 or 30 options. If you roll that into an IRA, LPL Financial, we're, I think, the biggest independent broker-dealer, one of the biggest. We have agreements with hundreds of different mutual fund companies. Edward Jones and Janney has the exact same thing. So what we can do is we can analyze your portfolio. We look at the funds. I have a Morningstar system, see how your account's done, the fees, everything like that. A lot of times that's a new discovery, the fees and things like that. So basically we can do that, roll it into an IRA. Now remember, here's what you want to be very careful about. Another warning, Uncle Sam. Take a lump sum distribution would probably be the last thing I would do. Why is that, Uncle Sam? Because you're going to get taxed. You're going to have to pay taxes on that lump sum. You lose the power of tax deferral. Unless you need all that money at one time, roll it into an IRA. If you roll it into an IRA, we can turn this alarm off because it's tax deferred. It goes in. You can continue growing to get tax deferral. How much time do I have left?
9:17.
Okay, so probably should wrap it up. I'm sorry.
You
Okay.
have minus 2 minutes.
Okay, balancing multiple financial goals. Children, I apologize, I kept this long. Children's college, retirement, supporting aging parents, balancing goals. Thank you for waiting this long. The financial impacts on caregivers, less flexibility, fewer job options, reducing pension and social security benefits, less money to invest in out-of-pocket expenses. Last will and testament, trust and insurance policies. So we do full service financial planning. And estate taxes, they change the estate tax exemption. I think it's about $6 million now that you have for the estate tax. So if your estate's over $6 million, that's when it'll be subject to that. But PA still wants to take their cut. So put your retirement action plan to work. We can do all this. Meet with me, so I don't want to take up any more of your time, or either one of these guys if you want to feel comfortable with somebody else. And we can do our plans, set your goals and timelines, and put your plans to work. Thank you for putting up with me. And any questions, shoot them.
What's the difference between small stocks and large stocks?
Small stocks means there's small caps, which the capitalization. So small caps, you want to be very careful with extremely small cap stocks. For a stock to be on a national exchange like the Dow Jones, the S&P 500, it has to pass certain criteria. It has to be at a certain capitalization. If it doesn't do there, it goes to you got to be careful. When I first got in the industry, this was a big scam. They're called micro-cap stocks. I don't know if you ever saw The Wolf of Wall Street. These are companies that basically, they're scams. They are really not doing anything. The promoters get them for like a penny on the dollar. And then what they'll do, hey, I got a hot stock tip. This thing's going to take off, man. Let's do 10,000 shares of this. And then the public will buy it at like $8 or $9 a share. All these idiots make all their money. They'll make millions, and then the stocks that people can lose money and it's worthless. So small cap stocks. Now, small caps on the Russell 2000, they are kind of undervalued. I don't really follow them too much. I tend to go with just the bigger things, but small caps that are legitimate, like in the Russell 2000 index, can really make. But they're smaller capital companies. They're newer companies. They're not like the huge, Microsofts. They're not like the IBMs and things like that. I was looking like the big stocks. That are still like the big companies in the 90s when I was there, like Microsoft's still there. There's only a couple of other stocks that are still in that caliber. But small caps are kind of like companies that could become the next larger cap companies. So if a stock has a large cap potential, you could really make a lot of money on that. So that's really the difference. It's just market capitalization. You take the number of shares times the stock price.
Yeah.
The shares in the float.
Where is everybody? We lost that most.
I'm sorry I went over that long. Thanks for hanging out.
It was good
Nicely
information.
done.
Thank you very much.
Thanks, Mike.
No, that was good.